This one is a trade management question, Coach Matt, and it's on Microsoft.
Okay.
So I currently have on a covered call on Microsoft.
Okay.
The contract I have, or the call I have, and this is now, me asking trade management, should I stay or should I keep the current one or roll it?
What
I
what
have
what do you do with the call? That's what I'm assuming the question
what
is about.
what do I do with this call? Help a sister out.
Okay. All right, give me the numbers, give me the strike prices, give me all the relevant information here, Em.
All right, I've got the Feb 17 250 call. That's what I've got.
Okay.
So I'm 17 days left. I've been in this for 15 days. So right now I'm at a net zero, no cash flow in this sucker. I've made the appreciation, so I'm not complaining. Okay, I bought it at 230 something. So I've made quite a bit of appreciation, but this call has not given me any cash flow. I'm looking at where Microsoft is sitting right now in the chart, and I like the technical. So my question to you is, with 17 days left in this contract and I'm targeting that 250, do I stay or do I roll to a 30-day and go 255 and give it a little bit more breathing room?
You want that 200 daily moving average. I know what you want. I do know what you want. When you're dealing with the covered calls, when you're looking at covered calls,
Mm-hmm.
covered call management is one of top side, downside, right?
Yep.
You want to manage the strike price on the top side, you want to manage the net liquidation on the bottom side. And
Mm-hmm.
so, and what I mean by that is the net liquidation is basically the $4.15, right?
Yeah.
You receive $4.15. You want to see that liquidated over time. That is net liquidation. You receive that, and the analogy I've given in is oftentimes is when you receive a credit in the market, it's your money, but you got to liquidate it. It's
Mm-hmm.
the trade's still alive. There's other sides of the equation there. And so you receive the money, but you got to liquidate it. And it's kind of like you hiring an attorney, right? You pay them some upfront capital. That's still your money. The attorney has to liquidate it through, billable hours and so on and so forth. And
Right.
so when you get this net liquidation, the first thing you have to talk about in covered call management is, all right, I sold the 250 strike price. If I want to see it above 250, well, you better do something with that call you've sold at 250 because you've given the right to the market to buy your stock at 250, right?
Mm-hmm.
And so first and foremost, when you're looking at this from just a technical perspective, technically, I would say you're probably fine to keep the call at 250 right now, technically.
Mm-hmm.
You are seeing an increase in support following a breakout, a little bit of a snapback technically here, which would lead to a 250 test. But I would also say 250 is a technical resistance zone that has some degree of relevancy. It was the previous pivot, for example, up here before you saw that snapback. So I do think 250 does have some technical relevancy there. But you're also underneath 250. And when you're underneath the strike price, I do often find it to be a mistake to do anything from a management perspective
Mm-hmm.
until you're starting to get threatened a little bit more at 250. Now,
Right.
that can happen quickly, given the fact that we have a lot of news in the next 48 hours, right?
Right.
And so having the conversation right now is important, but I still feel it's a mistake oftentimes for covered call management to over manage when the stock is underneath the strike price. When the
Mm-hmm.
stock is underneath the strike price, yeah, you might have additional concern, but you concern in the sense that it might get blasted, right? Technically, you got an increase in support, but I also do often feel it's a mistake by most covered call traders. I think they're micromanaging a long-term position to a certain extent, and micromanaging almost anything in the market is not necessarily a good management technique. And so I would say that would lead me to a conclusion that there might be some micromanaging here a little bit. But just to go with the question a little bit, The first thing I would look at here in making that decision is number one, how do I feel about 250? I'm going to look at that from a technical perspective. Before I would roll anything, I'd like to see that get blasted first, quite frankly, because that's kind of where technical resistance is.
Mm,
Literally, you hit it on the penny just last week before it came right back down. So I'd like to see that worked out a little bit. But also when you're looking at the management of the strike price, to a certain extent, you got to be looking at your intrinsic versus your extrinsic value. Of the
mhm,
$415 in net liquidation right now, 100% of that is extrinsic value, which means out of the next 17 days, 100% of that $4.15 is going to be worthless. Now,
mhm.
is there intrinsic value? Well, there might be, but it's got to break 250 for that to occur. And
Right.
so if you don't break 250, there's going to be nothing intrinsic. So right now, as we're staring down the barrel at 250 at 246, you're saying, okay, there's four more dollars before you even get into anything intrinsically value. And before any aggressive management technique is needed, you probably want to see the intrinsic value go above the extrinsic value, which means it's not even going to be at 250. It more than likely has to be somewhere around 252, 252 and a half for that intrinsic value to actually exceed the extrinsic value. And if
Mhm,
that happens in the next couple of days, even if the stock price is at 252, 253, you're most likely not getting called out there because, again, the extrinsic value is still going to be a little bit more than the intrinsic value is there. And so who's going to exercise their contract to buy your stock and pay you $4 of extrinsic value to capture $2 of intrinsic value? That type of conversation. And so
mhm,
that does give you a little bit more flexibility on making this decision. And so because you are underneath the 250 channel and because you have a rock solid resistance at 254, 255, I personally feel that the best decision would be to allow the 250 call to work out a little bit here. Remember, Microsoft is a wonderful company. It's a great covered call company. It's a Tackle 25 darling. It's been on the list for a very, very long time. Microsoft has also already been in a trending condition from a neutrality perspective for quite some time as well.
mhm,
I would say let's let that work out a little bit. I would also say that despite the market getting a little bit more bullish over time, we also still have tremendous overhead in the market. Remember just the conversation we were having earlier today in the S&P. It
mhm,
hasn't had that breakout of the 41. It hasn't seen that next catalyst to really build the confidence in that next leg analysis in the S&P. And so I think having a little bit of covered call action right now in the face of the next 2 days specifically probably makes a little bit of sense to mitigate some of that bullishness, to bring in a little bit of cash flow, to say, you know what, let me see the next 2 days. Let me see what the Fed says. Let me maintain being covered in this environment a little bit. Not on everything, but again, answering the question specifically to Microsoft, I think it makes sense as of right now to maintain the cover on Microsoft, specifically to you, not to everybody, but specifically to you. I would maintain the cover on Microsoft because we still have a quite a bunch of extrinsic value to go in that contract, and we don't
mhm.
have anything intrinsically yet to really kind of be worried about there. I think it allows you a little bit of flexibility to say, let me see the next 2 days. Because if the next 2 days bullish response, if the next 2 days provides a very bullish response, yeah, you got a good problem on Microsoft. There's no doubt you're probably talking about Microsoft at 250, 253. I still think you have the ability to make the same management decision after seeing that type of price action, though. So I would say, to answer the question, I would maintain the discipline of the cover call right now.
So keep watching the paint dry.
Yes, as we oftentimes do with cover calls.
Okay,
You got to
fine.
let it bleed. You got to let it bleed. What I've told you, the one thing you cannot force in covered calls is the amount of time it takes to liquidate the position from a
Yeah.
call perspective. It can be like watching paint dry on a wall sometimes, there's no doubt. But you know what is really, really good? Watching that 2, 3, 4% compound every single month as well. That adds up over time. And so micromanaging here, I think we just be a little bit more conservative. We maintain the discipline on the cover call.
All right. Well, I certainly appreciate that perspective
I
on
love
that.
that question, by the way.
I love and we do this every single month, and we just, we click the button and just, and just anticipate the net liquidation to just kind of take its place. But going through and having that discussion with the intrinsic and extrinsic values, and having that deeper understanding of like what's there to worry about if there's nothing on the intrinsic side, just keep
Nothing,
going.
yeah. Like nothing, yeah. And the thing is, if I felt 250 was the breakout channel, like the real breakout channel, and you could see a lot of momentum above that, I might have a different take, right?
Yeah.
But a breakout of 250 is staring down the barrel of 254, 255 with the 200 daily right there.
Right.
I would expect that to provide a little bit of resistance and give the cover call the decision on the call side of the equation. I just think you have time because the breakout channel also is not clean above 250.